Today, more RBA Fudge, the DFA daily till the 7th of September 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. I'm recording this on Tuesday morning. Of course, today the Reserve Bank will meet later and we'll get some brief comments from them this afternoon. And everybody's talking about what the RBA will do, so we should look at that. We'll also look at fraud in the banking system. It's much wider than many think. And we'll also consider what New Zealand is doing and also what last week's news with regard to employment in the US may mean over there too. And just before we start, a quick reminder that tonight at 8 p.m. Sydney time, I'll be running my live show and I'll be looking at what the Reserve Bank did and said today and also share our latest information relating to mortgage stress and household finances. Given everything that's going on at the moment, this will be an important show. So mark your diaries and join us at 8 p.m. Sydney tonight. But we start with Tuesday's RBA board meeting, which is clearly going to dominate domestic discussion and the price action on the markets this week. The ongoing debate about the quantitative easing purchasing pace will probably be resolved with the market response set to be fashioned by the RBA's associated rhetoric. I'll make the point that this is a really weird process. The RBA throws out a few comments and then economists spend the next few days a bit like priests trying to decode the message from God and trying to work out what the RBA means. The whole process is nuts, frankly. Apart from the announced pace of bond purchases, the key will be how deep the lockdown hit to the economy is going to be and how quickly the RBA expects the economic rebound to occur and when that rebound will kick off. So it's interesting to see what the banks have been saying. Westpac is now forecasting a 4% contraction in the September quarter and zero growth in 2021. But they say that should be followed by a 7.4% boom in 2022. But they said the risks are more than normal due to the health uncertainty. So they do concede that that is really just a guess. Now, the RBA will probably be getting advice that the contraction in the September quarter will be much greater than their previous advice of just 1%. And so the growth forecast of 2021 will be slashed. So there will need to be a policy response. Now, the question, of course, is what will that policy response be? Well, Westpac maintains that the RBA should respond by abandoning plans to reduce its weekly run rate to $4 billion and lift its weekly bond purchases by $1 billion to $6 billion run rate. Now, given that the August Statement of Monetary Policy noted that they would keep the rate of bond purchases under review in the light of the evolving health situation and is prepared to act if worsening health outcomes affect the economic outlook, it would be quite extraordinary if the board did not decide to at least very much delay the taper and maybe even expand. CBA has echoed their sentiment, stating that the hit to the economy from the Delta variant has been much higher than expected. With the hit to the economy from Delta-induced lockdowns far more significant than anticipated, we expect the board to stick with current levels of purchases through November, said the senior economist there, Ryan Felsman. The hit to the economy will also inform the view at ANZ, which said that the RBA should not allow the economy to continue contracting without stimulus to combat it. Doing so would place Australia at a weaker starting point for recovery, they said. The downside risks to the 2022 outlook have increased, not only for domestic reasons, given a slower China, and the global uncertainty posed by Delta, said David Plank, the head of Australian economics. At the very least, Australia's starting point for 2022 will be weaker, implying that wages growth and inflation are lower than previously expected. But on the flip side, NAB has suggested that a sharp rebound in Australia's economic situation is expected soon, which will give the RBA confidence to proceed with tapering. The bank highlighted that New South Wales is expected to significantly ease lockdown restrictions in mid-October, assuming the state reaches its target of 70% fully vaccinated adults by this time. Expectations for a strong rebound in activity after the current lockdowns remains largely intact, they say, though the optics of tapering and protracted lockdowns means it is likely to be a close decision, said NAB's Director of Economics, Tapper Strickland. At the time of NAB's 6 September weekly report, 40.8% of New South Wales adults were fully vaccinated, with 73.5% having had one dose. And Macquarie also expects that the reasons the RBA gave in August for proceeding with tapering would not have changed. The following statement from the August meeting was highlighted. The RBA said it would be prepared to act in response to further bad news on the health front should that lead to a more significant setback for the economic recovery. The term significant setback has led the bank to suggest that a relatively high bar will need to be met for tapering to be delayed. With momentum in pre-lockdown economic demand expected to contribute to a swift recovery once restrictions ease, Macquarie believes the RBA is going to emphasise that recovery remains on track despite current lockdowns. Now, over in New Zealand, interest rate markets remain hawkish. The local pandemic outbreak appears to be contained and unlikely to derail the Reserve Bank of New Zealand's tightening plans. Markets continue to expect an October official cash rate hike, with a follow-up in November and a total of 150 basis points by the end of 2023. Daily Delta cases have fallen from a peak of above 80 to around 20, and the spread has been contained to Auckland. The government announced a relaxation of restrictions for the country apart from Auckland, where Auckland will remain at level 4 for at least another week. So Westpac thinks that economic growth in the third quarter will be down 0.6%, but in quarter 4 they think it'll be a rebound of 0.9%. And by the end of the year, the aggregate activity level will be where it would have been absent the current outbreak, they say. Moreover, the supply chain disruptions inside New Zealand are likely to add further to existing pricing pressures. So the Reserve Bank of New Zealand will thus be motivated to start removing accommodation as soon as it can. Bear flattening will remain a market theme for some time, they say. Now elsewhere, both the Big Four and non-major banks have been found to have vast exposure to criminal activity, with Austrac suspecting high exploitation of home loans. The regulator has published risk assessments on money laundering and on terrorism financing, ML and TF, across the banking sector after engaging with the industry and other regulatory and law enforcement agencies. The overall ML-TF risk ratings for the banking sector have ranged from medium for foreign subsidiary banks and foreign bank branches to high for the Big Four and other domestic banks. Most of the suspected activity involved retail banking products and services, especially those that facilitate cash transactions or rapid transfer of funds domestically or internationally. Looking at the major banks, which hold around 3/4 of the banking sector's total assets and process the majority of Australia's international transactions, Austrac reported that they are vastly exposed due to their large customer base, extensive product offerings, and high exposure to cash. The Big Four served around 47 million customers during 2018-19 reporting period and overlooked 1.4 trillion in housing loans, covering 78% of the mortgage market. Further, the Big Four facilitated 3.5 trillion in international fund transfers during the reporting period, more than all other Austrac reporting entities combined. The assessment is partly based on a sample of 8,000 suspicious matter reports filed by the Big Four banks from April 2018 to March 2019, out of a total of 174,507 reports. Those matters related mostly to transaction accounts, 85%, but around 5% were linked to loan accounts, while 8% related to checkbooks, 6% to bank checks, and 2% to credit cards. Money laundering was deemed the primary threat facing the major banks, followed by tax evasion, drug trafficking, fraud and scams. about half of the serious matters sampled related to money laundering, while 2/3 of money laundering related intelligence reports from agencies involve the exploitation of at least one major bank. The Big Four are reportedly exploited at all stages of the money laundering process and across all transactions, whether international, domestic, incoming or outgoing. The purchase of high-value assets was one common methodology for money laundering, with the Big Four's dominance of the home loan space leaving them more exposed to laundering through real estate than any other financial subsector. And Austrac assigned home loans and credit cards as highly vulnerable perception ratings, while business and personal loans had a medium level. There was a high rating for known or suspected criminal misuse of home loans. Real estate remains an attractive destination for criminal proceeds, said Austrac. Serious and organised crime groups can use real estate as an investment or as a lifestyle benefit to integrate the proceeds of crime into the legitimate economy. The sale and purchase of real estate presents particular appeal to money launderers looking to conceal large sums of money in few transactions, or who use corporate vehicles and trusts to disguise beneficial ownership. Austrac's partner agency had reported cases where illicit funds had been used to repay a loan or to purchase an asset outright, as well as cases where real estate agents, mortgage brokers and luxury car dealers helped entities to launder criminal proceeds. And the report also referred to a number of cases of fraud enabled by mortgage brokers. Loan application fraud was the second most commonly reported fraud from the banks, following identity fraud. The non-major banks, meanwhile, faced displaced, higher-risk customers from the Big Four, and a number of the small entities were found to have less sophisticated and less resource anti-money laundering programs. Austrac examined 12 of the non-major banks, with a collective 5 million customers and 203 billion in housing loans, which is around 12% of mortgages across all banks. The primary threat facing the non-major banks were fraud, money laundering, scam and tax evasion, although the subsector was also exposed to terrorism financing and other criminal activity. Across the non-major banks sample of 2,698 serious matters, loan accounts and loan applications were identified in 7 and 8% of the reports, respectively. They commonly included applying for loans with falsified payslips or staged wages, or applied for loans with false identity documents, and immediate cash withdrawals or transfers, and paying off home and vehicle loans with structured cash payments to integrate illicit funds into the financial system. However, home loans were given a medium vulnerability perception rating at the non-major banks, with a medium level of detected exploitation, unlike the Big Four counterparts. Austrac Chief Executive Nicole Rose commented that it is vital the banking sector use the risk assessments to help them to protect their businesses, customers and the Australian community from criminal threats. We're navigating a rapidly changing financial system and advances in technologies and platforms. That is why government, law enforcement and the finance sector must continue to work together to protect Australia's financial system and Australians from serious and organised crime, as Rose said. The financial services sector has had the second highest number of data breaches of any Australian industry between January and July, and it's increasingly experiencing malicious attacks, according to the Office of the Australian Information Commissioner. Around 58% of the data breaches in the finance sector were considered malicious or criminally related. Further, loan application and identity fraud were deemed the greatest threats to non-bank lenders earlier this year, with Austrac noting the sector's reliance on third-party players. A couple of observations here. Firstly, of course, in Australia we've been very slow to recognise the risks in the real estate sector. In fact, there was a report some years ago recommending specific additional steps that could be taken around legal transactions and validation. They have not been pursued because, of course, the government doesn't want to slow the real estate sector. That means that we are definitely at risk. And if you look at Canada, where there's a similar story, we know that over there is a considerable amount of fraud and money laundering going on through real estate. So I'm pretty sure the same is going on here. It's just very hard to track down. But on the other hand, you also don't want to put so many barriers in place to reduce civil liberties and make it hard to do things the way you want to do them. For example, handling cash. So the key question is, what is the right setting to try and deal with the crimes whilst not getting in the way of individual transactions and civil liberties? That's the debate we should be having, but that's not the debate we are having. Rather, Austrac is just trying to put more pressure on the industry to make changes. And of course, that will flow through to the government saying, well, we now have mandates to tighten even further. And of course, governments like to take civil liberties away wherever they can, as we've seen recently. Now, finally, let's go back and think about the US, because one of the questions over there is how much of the near-term game changer was that August payroll miss last week. At less than 1/3 of the average of prior 3 months, August's 235,000 increase was a shocking outcome, particularly as those jobs would have been finalised in mid to late July, when new Delta cases were but a fraction of the current level. So Westpac says the key questions now are, first, did that August payroll outcome come about because of changing demand or lingering supply constraints? And second, how far off course does it put the overall economy in pursuit of full employment, which is a prerequisite for rate hikes? Well, they say, with regard to the former, we believe that August's weakness was due to supply rather than demand. However, we expect this outcome to be enough to push the taper announcement from September to the December FOMC. And note that, ahead of the August print, they had anticipated a material weakening in job creation from September, with gains from that point to end 2022 to average around 450,000. So it would need weaker outcomes than that to substantially derail the expectation for Fed policy evolution. So therefore, they say, we are maintaining our existing forecasted timetable of taper beginning in January and extending to June 2022. Beyond that, we also maintain our current expectation that the Fed's first rate hike will be delivered in December 2022. After some whipsawing price action, the US Treasury curve bear steepened, and the 10-year bond yields closed at their highest level in over a week. With $120 billion of supply, there is likely to be more curve steepening this week. And that's supported by the stronger than expected wages gains. But it remains to be seen whether a high yield trend exerts itself, and there's a key technical resistance at 1.38% and then at 1.41%. A breach of that, they say, would push us into the old trading range that prevailed earlier in the year, but they say, in our view, it is too early to expect a rapid repricing in coming weeks. Now, again, it's interesting to observe how many people have now changed their tune with regard to the US and are pushing out expectations with regard to Fed easing. My own view is that the Fed will continue to do quantitative easing for a long time yet, because they've got no way out. Same here in Australia. But then, of course, all those economists are tied to the major banks, and the major banks benefit as quantitative easing continues because it supports asset price inflation and more loans. So how objective are their opinions, I ask? Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again